Hello, hi. So today I just wanted to for us to discuss about market direction, and our intelligent gut feel kind of guess towards the year end. And just wanted, of course, there are a lot of bears saying that the Fitch ratings as well as um, um, the frothiness of the market that has gone up quite a lot, and then recession is actually coming in December, just has been deferred a little bit, or inflation has inching back upwards again with oil and gas prices going up a bit more than on a lowering down kind of curve. So if we have a contrarian view, we still think that actually the market is still there's still upside, broadening of the into other sectors from the Magnificent Seven, Industrial Russell Index, which is small to mid-cap kind of software company stocks. And then there are 5.3 trillion in cash on the sideline, as well as investors are still not really heavily into stocks at the moment. So I just want to show you a very interesting video on a thought process by Chamath, a very famous institutional investor. He has actually listed Virgin Galactic, many other specs as well, Global Health and all that. He did mention that it looks like the worst is behind us, and even though interest rates will be higher for longer, the market will continue to rally, especially for growth stocks, because when the risk assets, when we don't see so much risk out there anymore, even though earnings might be flatter than because of economy not really doing very well, but at the same time we are not getting a recession, so we are really like what they call it, the soft landing, and then risk assets might actually go up. So just let's hear from what Chamath has to say.
Where do I think the equity market is going to go? And all roads, at least right now, look like the market is getting set to go materially higher. And the reason isn't whether, terminal rates are at 2% or 3% or 3.5%. I don't think that matters that much. What matters more are the trillions of dollars that are sitting on the sideline or in other defensive assets that need to then pivot around and get put back into growth assets once you know that the worst is behind us. And I think that's what the market always looks for before real sentiment changes. And what's important to note is that by the time most people figure out that the sentiment has changed, it's already actually too late. And so I think right now in the next sort of like 12 to 18 months is really when the bottom is put into the market. It's before the Fed starts cutting. It's when rates are still going to be relatively high, but the really astute sharp in this market will get ahead of it, and they will start to buy what they think will be an eventual rally. And then it's going to get supported by the fact that if not enough people are also long, you get caught on the wrong side. You don't necessarily have to be short, you just aren't long enough. And what that does is put pressure on your business model. So if you're a mutual fund or if you're a hedge fund and you've missed most of this rally, which most people have because it's really only been 5 or 6 companies. So I think that Larry is right. I think that I still believe what I've said for a while, which is rates will be higher for longer. But what I didn't believe before was that the market was set to go up. I think we did a great job. I think literally that when I made that comment November of 21 about starting to sell, it was the absolute top of the market.
Yeah, you nailed that one.
Nailed it.
Yeah.
And I think my commentary now is that we're putting in the bottom. And okay. I think the market is set to go materially higher, even if rates are persistently higher for a while.
Just to challenge you on that second point, the bottom really was put in maybe last summer. You're really speaking to the psychology and the dynamics of capital allocation. There are people who were scared maybe and thought the bottom could get much worse, and they didn't want to put money at play. There were some people who were brave enough to put money in play in the last 12 months, and I'll give myself a pat on the back. I did J trading starting last summer, and I'm up, 25%, something crazy like that, because I picked all the big tech companies. But You're saying now, because
Well, that's a good example. Just to pick on that, the reason you did well was mostly because they were oversold. Meaning,
yeah, that
if you
was
look
my
at those
perception.
tech- If you look at those big tech companies, but that's not a sustainable thing if you're trying to own great companies. The reality is those 7 companies, one of them, Nvidia, is actually firing on all cylinders. Everybody else just stopped acting like a fucking moron. And that's not a sustainable business strategy, meaning, burning billions and billions of dollars a quarter totally wastefully with all kinds of random free stuff to a bunch of entitled
Side
employees.
projects, side quests.
Yeah, so as you can see, now we're not looking at companies that are oversold because pretty much they have recovered. But now we are looking at companies that has great growth, good earnings and not doing all those non-profitable side projects, laser-focused CEOs and all that. So something that we need to look at. So market has still got room to grow for sure. So yeah, that's all I have to say about the view for the 6 months ahead. And I hope you like the video, and please like and subscribe. Thanks a lot.